In a lease versus own analysis, the firm is trying to decide the best scenario for their needs. On the leasing side, the corporation can use the space without investing corporate equity, which means they'd be freeing up the equity capital for other investment opportunities that are available to them. On the owning side, however, that's essentially investing in real estate. The corporation may decide to finance the purchase by taking out a mortgage that would be secured by the property in addition to equity capital, or they may use only equity capital. The decision to own the space involves an additional equity investment in the property that is not required when leasing. So the corporation must consider the difference in the cash flow to the corporation if they lease the space rather than if they own the space. So for example, we might put together a cash flow a cash flow statement side by side showing if we were owning or if we were leasing, and then we could estimate the difference. So the cash flow from operations would include the sales, cost of goods sold, operating expenses, lease payments, interest, depreciation, and taxes. And then the cash flow from the sale, of course, that would be if they owned it and then eventually sold it. Those cash flows would include the reversion from owning and then any gain on that sale. And then we could summarize our overall cash flows by just netting out those two sources of cash flows. So whether the after-tax IRR is sufficient to justify the additional investment in ownership versus leasing the space depends on the opportunity cost associated with that investment of equity capital in the property. In other words, what other investments are available to the firm that they could use that money for instead of or as an alternative to investing in this real estate. So here's why the residual value of real estate is going to be important in these lease versus own decisions. A corporation that chooses to own real estate has also made an investment in its residual value. So how do we estimate that residual value? Well, that is the reversion value of the land and improvements at the end of the lease term. So some assumptions that we might make when we're making this estimate are that first, the residual value will be equal to the book value of the property, which is, remember, that original acquisition cost, how much we paid for it initially, less any accounting depreciation at the expiration of the lease term. Another assumption could be that there's no residual value because the residual sale price received must be reinvested in a lease or on a new facility at that time, because the firm would still need to have some property for their operations. So what other factors affect this own versus lease decision? Well, first, what are our space requirements? So leasing is going to be preferable if our space requirements are less than the optimal development on a given site. Second, the amount of time that the space is needed. So if the expected life of an asset is greater than our projected period of use, then it may be better to lease. So if we don't need the space for very long, then it may make more sense to lease than to own. Risk bearing. So larger companies with broadly dispersed operations are more likely to own than are smaller companies with geographically concentrated operations. So if you're talking about a nationwide entity, maybe a retailer that's got hundreds of stores all over the country, they may be more inclined to own their stores. But if you're talking about a sole proprietor who has a boutique in one city, it might make more sense for that company to lease. Another factor is management expertise. So leasing is going to be favored when the company does not have a comparative advantage relative to developers and others investing in managing property and eventually selling it. So what do you know about owning real estate and buying and selling and all of that stuff? If you don't have a whole lot of expertise in that area, again, it may make more sense to lease where you don't have to worry about a lot of those issues. Other factors, special purpose buildings. So companies are more likely to own buildings if they need to be customized for their operations. Tax considerations. If the lessor, so that's the person who's leasing, is in a higher tax bracket than the lessee, the lessor is the person who is making the lease, the owner. If they're in a higher tax bracket than the lessee, then leasing puts ownership of the asset in the hands of the party that can most benefit from the tax shelter provided by depreciation. Access to capital markets. So owning is going to be preferable to corporations with a high credit rating because the lease rate must cover the owner's cost of capital. Control. The corporation may want to control the real estate by owning the property. And lastly, the effect on financial statements. So real estate ownership can actually distort corporate balance sheets. So now what about financial reporting? So there's two ways that leases can be recorded, either as an operating lease or a finance lease. So an operating lease is a contract where the owner or lessor permits the user or lessee to use an asset for a particular period which is shorter than the economic life of the asset without any transfer of ownership rights. A finance lease, on the other hand, has to meet a few specific criteria. So the ownership is transferred to the tenant at the end of the lease term. The lessee, who's the user, has a purchase option that is reasonably certain to be exercised. The lease term is primarily for the remaining economic life of the leased asset, and the present value of the lease payments is substantially all of the value of the leased asset. And so that leased asset finally can't have any alternative use to the lessor at the end of the term. So what's the impact of a lease on an income statement and a balance sheet? Well, we mentioned before that it could distort the balance sheet. And so it's because of this problem of hidden value, because accounting conventions require companies to carry real estate assets on a lower of cost or market basis. So there may be value there that's not being reported. And many properties actually contribute little to their reported earnings. Some other special problems is that the cost for outside investors to ascertain or figure out the values of that real estate could be large enough to warrant a large discount. So as an outside investor, it's too much work for me to figure out what this real estate is worth, especially in the case of a large company who has a significant real estate portfolio. So I'm going to undervalue that real estate because I don't want to do the work, or I just don't understand how much it's really worth. Some other special problems are that investors may discount too heavily the expected future value of real estate because it doesn't produce any current operating cash flow. And then finally, because accounting depreciation charges generally exceed true economic depreciation, the reported earnings of real estate companies typically understate the level of operating cash flow.